lot of things have happened year to date in the market, starting with an unexpected Chinese recovery from lockdown, which has led the economic momentum to start with at the first half of the year. We've had the US regional banking crisis with some failures that have had the risk of bringing some risk of banking contagion and systemic risk. We had Credit Suisse, which had to be rescued by UBS with an orderly step in by the Swiss regulators. And we had the US debt ceiling debate that went to the 11th hour with potential risk of US government debt default, none of which have actually led to any material flare-up in risk, and the market has performed strongly, therefore, on that year-to-date period. In terms of specifics, we also had the euphoria of artificial intelligence with ChatGPT leading to a very strong take-up by users and the spillover into some of the stocks in the technology sector that have performed strongly, those notably that have been very exposed to artificial intelligence, such as NVIDIA. As a result, year to date, there has been a shift back towards quality growth stocks away from value, and that has helped Global Portfolio Trust given its persistent exposure to quality growth stocks. And pleasingly for us, despite the headwinds to performance last year, we haven't made any material changes to our stocks. We maintain conviction in the stocks that we had exposure to, and we maintain focus on quality growth companies. And pleasingly, those companies have performed strongly year to date, notably in the technology space, as I mentioned. The other aspect to mention is that not owning banks nor energy sectors have contributed positively. We actually wrote a piece earlier this year about the reasons why we don't own banks from a fundamental perspective, and really highlights the fact that we continue to focus on companies that have quality growth characteristics, solid balance sheets, lower regulatory risk, as well as companies that have the typical characteristics of a Global Portfolio Trust companies, which are companies that have resilient earnings, that have solid balance sheets, that have strong pricing power, and that have exposure to structural growth prospects across the three megatrends that we continue to favor. On the macroeconomic side, the other aspect during the year has been the fact that the US economic momentum has been stronger than expected, and therefore, coupled with the China recovery, this has reduced the risk of a recession. Our view at the start of the year was that both at the global level and at the US level, we were going to be able to avoid a recession. And pleasingly, more economists and more market commentators have come to our view that a recession could be avoided. That in itself has also helped support the markets.